Welcome, ladies and gentlemen, to Advisor Thoughts, where my goal is to explore the ideas, strategies, and philosophies behind elite performance in business, leadership, and wealth. Each episode dives into the mindset and methods of entrepreneurs, creators, industry leaders, and innovative professionals. My goal is to help business owners see the world through the lens of people who are at the top of their game. My name is Travis Blum. I'm a self-employed financial advisor and owner of the practice Blum Yonkis. We're a wealth advisory team who is partnered with IG Wealth Management. Today, I'm joined by someone who has been a steady and trusted voice through some of the most unpredictable markets of the past 2 decades. Philip Petursson is Chief Investment Strategist here at IG Wealth Management, known for translating global events into insights people can actually use. He blends data, behavior, and storytelling in a way that is rare in our industry. So, Philip, thanks for taking the time here today, and welcome to the show, sir.
Hey, Travis, thank you for having me. And before we get going, I just want to apologize if you do hear any barking in the background. There's a little dog just yapping away, and so might interfere in the conversation a little bit, but we'll try and keep things smooth.
All good. Man's best friend, right? Most of the time.
Exactly.
All right. So, before we dive into markets here, I'd love to start with, the person behind the perspective. You've been an anchor here at IG since I joined IG in 2021. When people think of someone like a chief investment strategist, they imagine probably someone who's, all about spreadsheets and forecasts. But when I first got to know you a little bit better here, especially I would say over the last year, it feels like you're much more of a storyteller at heart, helping Canadians make sense of, the not so small amount of uncertainty I think we've had, especially over the last 5 years. Can you talk to me a little bit more about your role and kind of what your goal is there when you're speaking and you're trying to translate typically these complex topics into layman's terms where people understand?
Yeah, you're absolutely right. I think in the world of investment strategy, it is often about spreadsheets, numbers, data, modeling, trying to figure out the direction that we're headed. And ultimately, while you're absolutely right, again, it is to make sense of the environment that we're in and where we're going. At the root of it is to answer the question, how do we make money? And that's ultimately what we're trying to do here. I'm not trying to solve the economic problems of Canada or the rest of the world. I'm not trying to address what the government is doing. I'm trying to figure out how we can best make money in the environment that we're in. And we believe that we're moving through over the course of the next, say, 12 to 24 months. And so that it does involve a lot of work behind the scenes in terms of understanding where we are in the economic cycle, understanding where we are in the business cycle, how that impacts markets from a valuation perspective, earnings perspective, interest rate perspective, where commodities are going, how that plays into things, and then trying to identify the areas of opportunity. And in particular, where we see market dislocations, where you can look at two different markets that normally move in a certain relationship with each other, but there's a disconnect. And that disconnect often opens up an opportunity to lean into one area of the market to realize potential for outperformance. And so that's what we do on an ongoing basis. Look, I really think of it in terms of the heart of it is the research. The heart of it is understanding everything that I just said. And then we have 3 elements to it. First one is working with you and on our advisors across the country and our clients across the country to make sure that we're positioned properly. And then the second element of that is the communications of all the research. So we do this through podcasts. We do this through venues such as what we're doing right now. We do quarterly videos. We do weekly write-ups. So we want to communicate to our clients and our advisors in the way that they want to receive the information. If you love spreadsheets and charts, I've got a ton of them for you. If you just want to hear a quick synopsis of what's going on, no problem. We have that as well. And then the third element is getting this broader IG message out into the world. And you'll see us, myself and my team, on things like BNN, CBC. You'll read about us in the Globe and Mail, all with our perspectives. And it's continuing to share the research that leads into answering that question. Okay, how do we make money in this environment?
Yeah, I feel like, especially in the last year or so, everywhere I turn, I get to see a clip of you somewhere. You seem to be a pretty popular figure especially online these days. I think you even mentioned in our last conversation, you're the most searched strategist out there right now, or what was that metric?
So we measured in terms of how many times we appear in the media. Our media relations team has done a phenomenal job of getting our message out there. So if you measure it in terms of myself, the representatives at the banks, or other insurance companies, or other asset management firms, yeah, I hold the number one position in the most quoted spokesperson in Canada.
That's amazing. Do you have people bring that up often during conversations now, with you kind of being so present?
Well, it's funny. It's a metric that isn't widely shared. It's something more internal. But where it gets interesting is when I'll be at the airport and I'll have someone come up to me because they've seen me and they know me through IG, and they'll be a client of ours that I will never have met, but they will, be very, very comfortable coming up and saying, "Hey, I watch you, every other week on BNN, or I saw you last week," or whatever it might be. So it's fun. It's fun when you run into clients that way.
Yeah, I've got to say, even when we look at our clients, it's such a nice extra layer when we get to speak about the fact that you are present in all of these different spaces, and usually, whether they're tech savvy or not tech savvy at all, there seems to be some sort of medium that they can kind of hear your message. And I would say, especially with all of the noise recently, that has been a comforting piece for sure. So, why don't we jump into that a little bit? Speaking of all the noise, if we look at 2025, and if 2025 were a book, I think it would be a bit of a thriller. And I'm curious to get your perspective on this. There's a ton of things that wrap into the narrative of 2025. First of all, we have, Trump being inaugurated late last year with the promise of tariffs that it felt like most people weren't really listening to or they were deaf to. Then we had Liberation Day, where the tariffs were in fact real, whether they were well thought out or not. That's an entirely different story. We had the U.S. Treasury liquidity scare in March, U.S. strikes on Iranian nuclear sites. We had gold breaking record levels. We had a historic election here in Canada with Mark Carney, who was the chair of the G30, all of a sudden the top dog to become Prime Minister of Canada here in an absolute historic election. When you connect all of these dots, what's the story beneath the chaos? Does it even matter in your world?
Well, that's a great point. That closing, does it even matter? And yes, it does matter to an extent, because volatility is just a function of the markets, and you never know what is going to trigger the volatility. And this year we've had a lot of it, to the downside and to the upside. Volatility isn't just one sided. But what's really interesting, and when you talk about if 2025 was a book, I think where we are today, you could reduce it to just kind of two pages. The first page is once upon a time 2025 started, and then go to the last page, which says, "And they all lived happily ever after." And
Yes.
that's kind of what we had this year when you think about it, because look at where the markets are today. We've had very, very strong returns out of the US equity market, Canadian equity market, international, emerging markets. Bonds did well in the low to mid single digits. Gold, as you mentioned, has done really well. And yet we had everything that you highlighted there as well, with all the political turmoil, with the wars that are still ongoing, whether it's in the Middle East, Eastern Europe, and that has kind of shaken the confidence of some investors. But I think the lesson through the entirety of 2025 is that if you focus on the fundamentals, if you let the data be your guide as opposed to the headlines, you've put yourself in a better position. Because there were many reasons to sell. There were so many reasons to sell. At the beginning of the year, it's like, well, Trump's threatening tariffs. Then he imposes tariffs that made no sense whatsoever, and the markets, responded quite negatively. We had the ongoing war between Palestine and Israel, and all these things that just kept popping up. So at any point in time, if you just looked at the headlines, you would say, "Man, this has got to be really, really awful for the economy, really awful for markets, and just get me out of here." And yet, what happened? And why did the markets respond as they did? Very simple reason: companies made money. Companies continued to grow their profits year over year. We had fantastic earnings this year out of US companies, out of Canadian companies, and other companies around the world. And that resulted in higher share prices. So ultimately, the market responded to the good news, not the bad news. And there were pockets of opportunity, April being one, that if anyone was sitting on the sidelines, and we put a note April 8th out on this saying, hey, you know what, you're never quite sure if there's a bottom, but man, this really looks like one. And we started deploying capital into equities at that point in time, and the results have been quite strong since. So yeah, it's almost like a tale of two markets. There's the headlines, and then there's the fundamentals that can be quite boring. And people don't want to focus on, well, our company's making money, well, our company's doing well, where are profit margins, what does valuation look like? That's all boring stuff. But ultimately, that is what leads the markets to higher levels.
So a few things on that. So I think one, I wouldn't mind just a brief explanation, if you will, on the VIX and kind of where we saw it go through this year, and how you use that as a metric to kind of help inform your position. So we'll start there, and then very curious on your opinion on the AI super cycle. So double pronged question there, but
Yeah. So first, let's
curious.
talk about the VIX, because VIX is really, really important to us in terms of what we do on gauging market sentiment and where we are perhaps in the market cycle. And when we talk about market cycle, it's like, peaks and troughs and valleys and so on. The VIX is also known as the volatility index. It's also known as the fear index, because what it measures is the amount of protection that investors are buying or building into their portfolios, to backstop any potential downside risks. So, the VIX will be anywhere between, say, 15 and 25 on any given day. And that just is normal market volatility, right?
Mhm.
Every day the markets will be up or down by a little bit. But what we saw leading into the first week of April, remember, we had Liberation Day where Trump stood in front of this, billboard and started slapping tariffs on countries and places that didn't exist as a country, but had a tariff imposed on them anyway. And the market responded quite negatively to this, because the tariffs really didn't make much sense in terms of how they came up with that calculation, and they were presenting quite a headwind to economic activity. As you saw the market respond to that, the VIX tends to go up. Right. And so you see the fear and the volatility increase. And usually what we've seen historically, the VIX has been around since the late 80s, but so since that period of time, when the VIX breaks above 30, that historically marks the bottom of a bear market or a correction. And we saw this, it was the 5th of April. It was a Friday. I was in Saskatoon, I remember, and I'm following it along on my phone, and the VIX broke above 30. And I remember being in a meeting with some of our colleagues and said, well, there we go. We're probably near the bottom of the market, right? How do you know? Well, the VIX, when it breaks above 30, historically, that means that you're near or at the bottom. And we take some confidence in this, because 90% of the time when the VIX breaks above 30, your 1 year forward return is positive with an average return of 22%. So those are great odds
Wow.
to start to take advantage of the market volatility. And what did we see really since then? Well, it was the 9th or 10th of April, so the following week, where Trump reversed course on the tariffs, and he pulled off and said, fine, we'll put a 15% tariff on the countries for 90 days. That allowed everyone to breathe a little bit easier. And from that point, the markets pretty much went in one direction through the remainder of the year, continuing to hit new highs along the way. So that was the positive that we saw. You got rid of the noise. We could manage through the tariff tantrum into a better environment. Now, fast forward to where we are today, and the headlines are dominated with AI bubble or AI super cycle, right? And some people will claim that we're in a bubble. And are we? I think it's irresponsible to say no, we're not in a bubble, right? We don't know. We could be, but is it a small bubble or a big bubble? We would say right now, given valuation, given what companies are investing in, given the results that we're seeing out of AI technology, it's a pretty small bubble. It's certainly not where we were in 1999. In 1999, you had companies like Cisco and Qualcomm that were trading hundreds of times of their earnings. Now, the biggest AI companies out there, NVIDIA, is trading at 45 times earnings. Well, yes, that's elevated, but it's nowhere near where we were back in 1999. So we're very comfortable with this environment that we're in. And what the other thing that allows us to be a little bit more comfortable is the money being spent on AI technology. It's being spent by the big players, your Nvidias, your Microsofts, your Googles, and Amazons and Meta and so on. And they're spending this money out of cash flow. They're not raising it out in the debt markets. Now, Oracle is a different story. We can talk about that if you want. But the majority of the money that is being spent on AI is coming out of actual earnings. And that we see as a positive, right? And that it's not like where you have venture capital funds throwing money at these .com companies that have a good idea that's written on the back of a napkin, right? That's not
Right.
the case today. What we're seeing today is these are companies that are developing this technology, developing the infrastructure around the technology, and I think the results will be proven out. Perhaps not for a couple of years yet, but right now, I'd say this is a very, very different environment. And to say this bubble is about to burst, I think is vastly premature.
Yeah, I no, really good perspective on that. I would agree. It feels like um, the spending is intentional, and to your point, it's not coming from venture capital firms where it's artificially blowing up valuations. You did mention Oracle there. I am curious about that. That's actually on my list of questions here. If you want to jump right into that, we
Yeah,
can go there next.
absolutely. So what we saw at Oracle was contracted by OpenAI to develop data centers. So one thing about AI is it takes a lot of computing power. And
Mhm.
so you've probably heard or read about these hyperscalers, and so developing massive, massive data centers, warehouses full of servers to basically run the computations necessary for AI generation. And so Oracle has been contracted to do this. And if you remember, the day the announcement came out, Oracle stock popped 40% in a given day. Now it's given back a lot of that. Now, in order to do this, Oracle has to borrow. They borrowed money to get the shovel into the ground and start developing these things. Now, some people say, "Oh, here we go." Now you're borrowing massive amounts of money. This is a danger. Again, not necessarily. The money is going into infrastructure. It's not being spent on advertising, not being spent on bad ideas. And so, could we see an overspend in this area, given all of the data center build out that we're seeing? Sure, we could. But is that the story today? Not necessarily. So, look, I think Oracle, their debt is very, very manageable based on the commitments being made. This is still something that has to be developed over the next couple of years. And so it remains to be seen. I do think that the retracement in Oracle stock has been justified. The pop up by 40% was probably a little exaggerated. Likewise, I don't think that, diving into AI companies right now is going to net you the same kind of returns that we've seen over the last couple of years. I mean, it could, but we have to be a little bit respectful of valuations. Again, coming back to it at this point, the money being spent, I think, is being spent wisely, not frivolously. And I think it will generate the results. Not every company will win. We know that. There's going to be just one AI winner out there, we believe. But you'll have the best AI out there. But that doesn't mean that the money being spent elsewhere is just being wasted.
Yeah, and so with companies like Oracle investing heavily in infrastructure, it's essentially to support an area or a technology that we saw with DeepSeek last year, where the tech is disrupting itself, and it's growing at such a pace that it feels like there's not a hose big enough to really kind of give it enough fuel, if that makes sense. So is it a risk that they're overspending, or is it something where, okay, if we end up having too much of this asset, we can spin it and sell it off to another company and kind of ease some of the debt worries that way?
Yeah, it's a great question. I think Mark Zuckerberg had a great quote where he said, "Look, I'd rather overspend on it right now to make sure that we're in the game than not spend it all." And then the other comparison I would say would be to what we saw in the late '90s with all of the fiber optic cable that was being laid to basically increase bandwidth for the internet. Early on, it was probably too much infrastructure, but eventually all of that infrastructure got used and utilized and paid for. So I think it might be too much right away, but eventually we know. Just think about how much we are going to be integrating AI into our businesses and our lives.
Sure.
All that computing power will be utilized, if not today, at some point down the road.
Fair enough. So speaking of down the road, in a world that constantly demands forecasts, I mean, that is a big part of your role, obviously with our iProfile product and commentary in general. How do you stay grounded kind of in perspective rather than in, just being the guy that predicts everything?
Right. Well, first off, so forecasting is really interesting because to do it accurately and consistently is extremely difficult. And so what we don't do is we don't come to the table and say, oh, we think the TSX is going to be 33,570 next year, right? You can pick a number and you might be right, but it's going to be based more on luck than anything else. Right. What we do though on the forecasting side is again try to identify these dislocations in the market and try to identify what area of the market is poised potentially to do better than other areas of the market. And if we could do that consistently, and we have, then you can put yourself in a better position. So we're not necessarily saying, oh, we think the TSX is going to be up 15% and the US is going to be up 10. When we run through all the numbers, we say, hey, we think there's better potential with the TSX than with the S&P 500. Therefore, we should lean a little bit more towards the TSX, as we have this year, and it's paid off with the TSX outperforming and international outperforming. So that's the way we think about it. We do come into it though to get to that point of view. You have to have an idea of the return potential, right? You can't just say, I think Canada's going to do better. Well, why? Well, I just feel that way. No, you have to sit there and say, well, earnings growth is based on all of the metrics that we follow. Your earnings growth year over year is set to come in at 12%, give or take, but let's use a base case of 12%. We see similar in the United States. Okay, what about the contribution to a change in valuation? Well, there we see greater opportunity in Canada because we're trading in the middle of the range of the 20-year valuation band versus the United States, which is at the top end of its 20-year range. Okay, so there's less upside from a valuation metric in the United States than Canada. Great. So that could mean Canada could add 3 to 5% in additional performance coming from that. Then from there, we say, what if we're wrong and things are better than we think? And what is the realistic upside potential? And then what if we're wrong and things are worse than we think? So what's the realistic downside potential? And then we know historically what the probabilities of these outcomes could be. Based on this economic environment, based on what we see from the interest rate, inflation, and what the government's doing in terms of spending. Here's your kind of base case probability, your bull case probability, your bear case probability. And then with that combination, you can sit there and go, okay, in each of these scenarios, yeah, Canada looks better than the US. We should lean into Canada. So that's to say that at the end of the year, if we're up 15%, 18%, 22%, 6%, whatever it is, we believe that Canada will do better than what we see in the United States. But trying to get that forecasting number, again, in the past I've done it and nailed it. But when people say, oh, what a great call, it's like it was luck more than anything else. All we knew was that we were in a positive environment for equity returns.
Speaking of that, you used a quote recently that is from one of my favorite movies, Jurassic Park. A butterfly can flap its wings in Peking, and in Central Park you get rain instead of sunshine. What element of that is kind of always in the back of your mind? Because at the end of the day, what you're trying to forecast is about as chaotic as it gets. I would say you've got so many contributors to what the outcome could be. How do you deal with that?
Okay, so here we can go deep down the rabbit hole into, I dug deep into chaos theory and fractal market hypothesis. So we're going to get really deep here and nerd out, right? So you may regret asking this question, but
not even a little.
But so let me take it back to kind of the basic of what a lot of people say with the market. And they say, well, just invest because markets are up, equities are up 70% of the time. So all you got to do is rely on that we're up 70% of the time. And yeah, over a very, very long term, if you look at equity market performance, whether it's the TSX or the S&P 500, over a 50-year period of time, yes, we're up 70% of the time. But you shouldn't rely on that, right? Because that's assuming it kind of like a normal distribution of things. So where we get into, kind of the butterfly flaps its wings and something else happens here is this, that sometimes those probabilities are 90% expectations of a positive return. And sometimes there are 40% expectation of a positive return. And so when you look at where we are in the environment, it's like the branches, it's like, well, we can go off in these branches, unlikely to go all the way back to where we were, 10 years ago. You're going to probably step up or step down. And so that is at the heart of what we look at. We really try and get a sense of where are we in the economic cycle, because that will lead to probabilities of outcomes that if growth is accelerating, which right now our metrics would say it largely is, and inflation Actually, in this case, it really doesn't matter if inflation is increasing or decreasing. As long as growth is positive, you have an 85% probability of a positive return in the equities over the next 12 months. That's,
Wow.
a great probability. I mean, you walk into Vegas, any casino in Vegas, and they say this table has an 85% probability of payout, you're going straight there.
Absolutely.
And so that's what we think. And then there's other times on the other side where it's like, okay, hold on a second here. We're seeing risk in the economy. We're starting to see recessionary pressures build. We're starting to see manufacturing decline. That leads to a recessionary outcome. And guess what? In a recession, the markets are only up 40% of the time, right? In a 12-month period. So that's where you want to lean more defensively. And so when you break down the stock market expectations into all those different outcomes, it's actually a little bit easier than you're sitting and saying, well, the market's up 70% of the time. Well, I want to avoid when the market's down. So you need to identify the unique environments when the probabilities work against us and position accordingly, which was 2022, for example, or when the opportunity set is quite strong, and then lean into it, which has been 2025 since April.
That actually kind of leads us into your jigsaw analogy. You've used that. I think that was one of the first things I kind of heard you comment on. And is that, is that the jigsaw analogy at its core, right? In terms of like adapting chaos theory?
That's it every day. So imagine you're coming to the table and you've been working on this jigsaw puzzle, and the next day you get up and you go to the table and the picture's changed. And it's like, okay, well, now we got to adjust, right? And so that's it with every new data point that comes out. Every quarterly result that lands on our desk, it adjusts the picture a little bit, and so then you have to adjust. We think of it as, for example, we just put out our 2026 outlook a couple weeks ago. Well, it
Hmm.
doesn't stop there, right? It's not like, okay, well, now we're done. We'll come back next October, see how we did, and then do our 2027 outlook. It's a constant reevaluation of the environment. As the data comes in, what is the trend? Where are we headed? How do we adjust? Or another way to think about it is you got the cold nozzle and the hot nozzle, and you're trying to get the right temperature, but the temperature of the water coming out can change periodically. So you got to keep adjusting as you go to make sure you're hitting that sweet spot of temperature.
So, speaking of kind of monitoring the data, let's, it may not be as timely now as we get closer to mid-December. It feels like gold was the hot topic about a month or so ago, but let's talk about the value of gold for a minute, because I still feel like this is a bit of an evergreen conversation. When uncertainty is introduced into the markets, gold seems to be at least one of those asset classes that investors are interested in attaching themselves to or buying more. You've actually built a model that is linked to the USM2. The USM2 is essentially a broad way to measure the total money supply in the economy, or in the U.S. economy. Is that fair to say?
That's exactly fair to say. So what years ago, if you think about it, I built a model to understand the valuation of gold. And this is the tricky thing, right? Because everyone will have an opinion on gold, but it's like, well, why? I think it's going up, but why? Right. And a lot of people go to inflation, say, well, gold's a great inflation hedge. Well, if you actually model gold to CPI, the Consumer Price Index in the United States or Canada, it doesn't track to that at all, right?
Right.
It deviates from that. So is that a good measure of gold or a good measure of inflation? Probably not. If we think about what gold has done over time, it preserves wealth, and it maintains purchasing power. Okay, well, what does that mean? That means that, if you had a dollar today, does it buy the same as a dollar 10 years ago, 20 years ago, 50 years ago? No, it doesn't. We know it doesn't, but gold does. And that's that store of wealth and that protection of purchasing power that it exhibits. And so, it was about, I don't know, close to 20 years ago where I built this model where, trying to look at saying, well, how do we measure gold then? Well, gold should be measured by the medium of exchange, which is, the US dollar, or you can use global M2. So M2 is all the currency in circulation, including deposits and GICs or CDs in the States and so on. And what I found is that, post Bretton Woods, when the US moved off the gold standard, gold still tracked M2, or what it meant is if the US dollar wasn't necessarily backed by gold, the value of gold was reflecting how many dollars were in circulation. So the more dollars in circulation, the higher the value of gold goes up. Now, this thing isn't perfect, right? Like gold doesn't track it every single point, but it always comes back to it. Over the last 50 some odd years, gold has always gone back to the fair value as measured by M2. So then it's very easy to turn it into a valuation model. And so a few years ago, say 3-4 years ago, gold was significantly undervalued relative to M2.
Mhm.
We had the massive increase in cash in circulation post COVID through the payroll protection plan, through Trump's checks that he was sending out to people. That was all money that didn't exist prior to 2019, and so it was inevitable that gold would eventually catch up. All right, so fast forward to where we are today. Gold is caught up. In fact, gold is at the top end of its fair value range. So, it's not, you can never just be on the fair value line. You got to have a range to it. And so it's trading at the top end of it. Does that mean that the run in gold is done? No, because we know the US continues to print more money and money supply continues to increase. They continue to run a deficit of 7%. And it is a little bit of the theory of like this debasement of the US dollar. And so, I do think gold can continue to move up, but are we talking another 60% like we've seen this year? Probably not. But 10%? Sure. Yeah, I think gold can get to 4,600, 4,700. I think that's very reasonable over the course of the next year. But the big run is done. Now, we own gold in our portfolios. We've owned gold for over a year now in our portfolios because we still like it. Are we trimming it? Not yet. Because we still think gold can keep pace with the equity markets and outperform fixed income markets. So it's a good asset to hold. So we like it, but would I be running into gold right now? No, I wouldn't be running into it because again, the returns are still there, but not as great as what we saw over the last 6 months. So sizing of positioning within portfolios is always very important when it comes down to things like gold.
How much of an impact will, retail investors who are seeing now that gold has done so well and probably rushing in to buy a little bit of that asset now, like how much of an impact will that have? Is that where you're kind of expecting to see the valuation raise a little bit
Yeah,
above
yeah,
where
exactly.
it is
That's
today?
exactly what we're seeing. So gold, largely, the buyers of gold have been central banks more than others over the past, say, year and a half to 2 years. But we've started to see since like early in the summertime, retail investors pick up their interest in gold. And so we measure it based on the GLD, it's the ETF in the United States. And you can see as investors are buying into this, the net new issuance is going up. Now it's not back to where it was a few years ago. So I think there's still room to go. And I think retail investors or average investors are still attracted to it because they've seen the returns and they're like, oh, I don't own any gold. I should own some. And so that can be another leg up. Again, could we see gold up 50%? We could. It's, I think, a less likely scenario versus what we saw a year ago where it's like, yeah, gold could be up a significant amount. To the question though is, could that be a driver of performance for gold? Absolutely, it could.
So let's shift gears a little bit, maybe a little bit more towards indirect wealth preservation and real estate here in Canada. I think the stat I've read recently is that 73% of the average Canadian's net worth is tied up in some sort of real estate, typically their principal residence. We had a discussion back in March, and I don't know if you recall it or not, but you actually did the math on your house's appreciation versus the market. And I'd love for you to kind of reshare that if you can, because I thought it was really interesting and to be fair, a very data driven take towards, should we invest in real estate or should we invest in the market?
Yeah, data driven is exactly the way to put it. I mean, just put it to a math nerd to sit there and all of a sudden break the calculator out and start figuring out, exactly what the return is. So it came out of a conversation with a couple colleagues of mine, and we're talking about housing. And I bought my place 25 years ago, and they were sitting there and they said, "Oh my God, you must have made so much money on it." Well, first off, you only make money when you sell. So yeah, and I'm not looking to sell anytime soon. But then it was like, well, hold on, think about it, right? So yes, we've seen significant appreciation in my neighborhood from when I bought to where we are today. But when I said, I don't know if I can say that I've actually made that much on it. And what do you mean? I said, well, let's start factoring in taxes, right? You have to pay taxes on the house, and it's property tax. So we don't pay a you don't pay a capital gains tax on the house like you do with an equity, but you have to pay property tax on the house. Okay, so let's factor that in. And then, there is maintenance on that. You have to replace the furnace, you have to replace the roof, you're doing upgrades to the house over time. That's money in. And yes, you think you get that when you sell it, but that's still money into the house. And then you have the other maintenance costs going along with it. And at the end of the day, when you factored in all that additional spending, the gains turned out to be 3% a year. So not
Wow.
bad, but not this stellar, it's going to be the massive wealth generator that you think it is, because, you still have to put money into it. And this is where you can make the argument, not saying, look, everyone needs a place to live and I think you should buy a house, but the question of, okay, what do I do with the excess? Do I buy another house and rent it out, or do I invest it in the market? And this is where we could debate this and bring in real estate experts. I am not one, but a 3% return after upkeep, after maintenance, after everything else, versus you look at the S&P 500 being up 9% since 1970. That's fairly attractive. And you make that investment once, I don't have to keep putting more money into it every single year. So it's just a different way of thinking about investing in real estate versus investing in stocks. Each have their attributes. I'm not saying one is necessarily better than the other, but we shouldn't just look at the final price of that house and say, oh my God, you've made so much money. It's like, well, I put in a lot of money along the way too.
Yeah, there was an inherent cost into that. We actually come up against this once in a while in our planning conversations with clients. And my business partner, Tommy, always has this line. It's like, if you want to go on a trip in retirement, it's not like you can take the doorknob off the front of your house and use that to pay for your trip. At the end of the day, we've got to find a way to create some liquidity here, which, isn't as much of an issue when you have a good amount of your assets sitting in a non-registered account, for example. Okay, apologies for the interruption, but just a quick note for any advisors listening. A big part of our work today is partnering with advisors who are thinking about their next chapter. Maybe you're a few years from slowing down, or maybe you just want the peace of mind that your clients will be cared for the way you've cared for them over the years. One thing that we're very proud of is the sheer volume of transition experience our team has developed. We've guided advisors through some of the largest practice transitions in the country, helping them either join IG and build a true planning powerhouse for high net worth clients or craft a succession plan that protects their legacy. It's experience I'd confidently put up against almost any practice in the country. If this is something you've been thinking about but haven't really known where to start, please reach out. We've built a model that makes succession feel a lot less scary and a lot more strategic. Back to the show. So if you were running a private business, this is obviously typically outside of your purview, but what lessons from the world in 2025 or even over the last, decade or so would you apply to your business if you were running a small or a medium-sized business?
Yeah, it's a great question. I think when we look at it, it's a tricky one, but I would say one of the things that we often focus on with companies is the return on capital versus the cost of capital, and then the total achievable market, right? And so if you think about a business, and I think this would apply to big businesses, small businesses, if there's an opportunity to take advantage out there, expand market, I would say don't be afraid of debt, right? Debt isn't a bad thing as long as the return on that capital that you can generate as a small business is greater than the cost of capital. Then businesses should be doing that every single day. And so that's something that I think a lot of businesses get. When we look at it, there is an optimal debt to equity ratio that we look at with companies, and saying, well, look, this company could certainly expand its business. It doesn't have the capital to do so, but it can go to the equity markets or go to the fixed income markets, the lending markets, and get that capital to expand its business, to grow its market share, and then compound those returns over time. That's a great lesson. I mean, that's one of the lessons of owning real estate, right? Like you buy it, I'm borrowing the bulk of the money from the bank, but the house, will appreciate over time greater than the cost of interest on that house. And same thing with the business. If there is that opportunity to say, hey, we can expand over here, we have to raise debt to do it. Well, yeah, do you think the return will be greater than the cost? Yes. Then the answer should be go ahead and do it. And we've gone through a couple of different interest rate regimes over the last 5 years, right? We've
Mhm.
gone from extremely low interest rates to an increase in interest rates now to normalized interest rates. And along that way, you've heard, oh, we've got this coming debt wall or massive, credit crisis. And we haven't had any of that because the opportunities have been there and the returns have been greater than the cost.
Yeah, there was There was a massive fear, I think, especially over the last couple of years around mortgage renewals specifically. At one point, it was playing into, I think, almost 1% of our inflation in Canada was attributed back to mortgage renewals.
So it was
Is that
probably even it was more than that at times. Yeah, majority of the inflation was coming from the change in interest rates and the change in housing costs. And you're absolutely right. You know, that was the thing. And we've watched it too, because we've seen anyone renewing a mortgage today versus a 5-year expiring rate. You know, that current 5-year rate is double what that expiring rate is, and so that is an impact. And it is having an impact on the housing market. We're seeing prices come down. We're seeing some forced selling, but it hasn't been the disaster. And why? It's because, you know, well, look, you need a place to live. You know, if you have to cut back in other areas, then fine. Then our mortgage goes up and we spend less elsewhere. But it hasn't been the disaster that some thought a few years ago.
It's interesting how all of these, theories ahead of time, they seem to be so much bigger than what they actually amount to when you see them kind of come to fruition, so to speak, and the impact they make in everyday people's lives. Not saying it hasn't been difficult. I'm sure it's been difficult. I'll let you know next July when our mortgage renews, but from a broad view, it doesn't seem like it's been nearly the meltdown it was positioned it was going to be.
No, and it's almost like, if you think about it, anytime we hear bad news, we revert to our teenage selves, where it's like, oh my God, the world is ending.
Yeah,
Right.
the
And
sky is
and
falling.
we got it. Yeah, exactly. Oh my God, I'm never going to live through this. Well, just, let's step out of our teenage selves back into our adult selves and go, yeah, we'll manage. Everything's fine.
And do you think the situation between the US and Canada is similar where, back in March it felt like the doom and gloom, from an advisor perspective felt even higher than what it was, at the beginning of COVID, believe it or not. Like it just like there was just this heavy layer to it. And I don't know if it was because it was political in nature and not, an unknown kind of entity creating chaos. Do you see this kind of playing out in a similar fashion where it feels like we're adjusting?
Well, we've been adjusting well for a couple of reasons. One, it's about 90 some odd percent of all the products exported into the United States are covered under the USMCA. So they're not impacted by the tariffs. You know, where the impact on the tariffs is coming through, some like the steel exports, the aluminum exports, right? And yet companies are finding ways to minimize some of that, where they say, yes, this is the cost of the raw aluminum. That is what is to be tariffed. And by the way, our engineering costs are these, and the logistics costs are these, and marketing costs are these. And so they can massage things a little bit that way. But there is this unknown of what does US really want? Right? Like, we still don't know that. What do they want? They
Mhm.
say we want factories back in the United States. And well, is that reasonable to expect? Probably not, because
Do
you
they
don't
know
have the.
that?
Yeah, exactly. Do they? Yeah, they don't know that. So this is, I think, the tricky thing with the negotiations. Like, well, tell us what you want, and we can negotiate our way through it. And it's like, well, what are you going to give us? Well, we're not going to give you anything until you tell us what you want, right? And so that does create the uncertainty. And then we have next year with the USMCA, the renegotiation of that, and we have no clue right now, at least in terms of what's being reported, what the potential outcome might be. There's everything from just tear it up completely to, no, we're going to massage on the margin. We don't know. So it creates some uncertainty. It does create some challenges. What we shouldn't do, though, is let that unknown turn into panic. Yeah, and that panic is what we saw in the markets early April, because that's when people make mistakes, and you end up doing significant harm to portfolios. So let's just wait and see what happens. There's still, a fair bit of time between now and then in terms of the negotiations that are going to go on. Clarity in terms of what actually the US wants to achieve out of any renegotiation, or the tariffs, or whatnot. And by the way, I mean, the tariffs could still be struck down by the Supreme Court,
Sure.
and that's what some of our research partners are indicating. That doesn't mean that there won't be any tariffs or other measures, but yeah, it's there's still unknowns out there. Let's focus on what we do know, which is companies are still doing well. They're still managing through this. They're making money, and they're being rewarded in terms of higher share prices. So for now, that's the end state of where we're at.
Great perspective. Not letting the unknown become the voice of fear in the room, I think is something we should all hold on to right now. You've had a really great career so far. So for anyone who's listening who wants to do something similar. They want to become a trusted voice. What advice would you give them, or what early lesson did you learn along the way that's kind of helped set your trajectory so
Well,
far?
yeah, Travis, I got to say, I did not start along this path at all. I started more on the marketing and the product side. And I think that helped me in terms of making sense of the market. So I wasn't just a numbers guy from the beginning. And then you can get lost in numbers. But I would say what perhaps has helped is a very, very good sense of curiosity, and that's with respect to what I do or what you do or anything. It's always been like, I wonder what that's like. I wonder what that's like. I've done a number of different things early on in my career that led me to this path, and I love what I do. But it was that sense of curiosity, and not marrying myself to I'm only going to be, a fireman, and that's it, right? It's like, no, try and find things that open doors. The more doors that you can open career wise, the more opportunities you have to explore and really figure out what you enjoy. So, I mean, I like this, but it's not for everyone. Just like some people are fantastic at logistics, project management, whatever it might be. So it's really kind of open yourself up, stay curious, and that curiosity will lead you, whatever it is, to I think your desired.
Great advice. Yeah, even with this show, I've enjoyed some playful ribbing from colleagues and friends alike. I've got to say, putting your ideas and your voice out there, it's not an easy task, and obviously, I would say, especially in a role like yours, you're always open to criticism, maybe constructive or otherwise. So I have a lot of respect for what you do, Philip. Final question here: if we could take one idea or one thing away from the discussion points we've had today, or something that you think is incredibly valuable for this moment in time, what would it be?
Well, we always come back to kind of the general principle of discipline, right? I am the biggest advocate for financial planning. I've got a planner that I work with, and I often say, look, I can build a portfolio. I mean, I'm invested in my portfolios, right? So, I'll just about all of my money is in the portfolios that I manage on behalf of all IG clients. The way to success, in terms of my thought of what I would provide in terms of any advice, is that it's the planning. Yeah, it's the proper planning, utilizing the accounts that are available to us, tax-free savings accounts, RESPs, and so on, to put yourself in a better position so that money is not a worry. And it's actually easy to do if you follow your advisor's advice, right? It's not that difficult. You get in the habits and you do it well. Where people kind of run amok is when they walk into the back of the restaurant kitchen and start telling the chef, saying, "Oh yeah, I can make spaghetti too. Here's how I do it." And it's like, I don't take my 10 years of education and 20 years of experience and turn it into a can of ragu. There's more to it than that, and really it's the planning that I think is the most important aspect to it.
That's great. I appreciate you giving that advice. Listen, thanks again, Philip, for taking the time today, for joining me here, answering some of these questions. I know it was a hard hitting bunch of questions here, really, really provocative, but nonetheless, I appreciate all the time.
Well,
Thank you,
thank you,
sir.
Travis. A lot of fun, and I look forward to the next time.
All right, me too.